Welcome back. Let's talk to Alessio Rastani. He is the founder and CEO of leadingtrader.com, and they are a leading trader education company. Morning to you, Alessio. Right, let's kick off. 2 slides on Elliott Wave. I'm an old cynic of Elliott Wave, fifth wave extensions, fitting the price action.
Yeah, actually, you have every right to be a cynic or a skeptic of it, because I used to be one of those. I guess it's a bit like a religion, and actually, to be honest with you, Nick, it is, Elliott Waves for a lot of people is like a religion, because there are people who are, I would call Elliott Wave fundamentalists, similarly like you have religious fundamentalists. And these are folks who would never dare anyone question the rules of Elliott Wave theory, which is why they get it wrong so many times. I mean, here's the thing. If you want to know why Elliott Wave technicians and experts get it wrong so many times, it's because they want to fit the market, or they want to fit the chart into their version of Elliott Waves. That's completely wrong, which is wrong to be a fundamentalist. The correct way is to actually do the other way around. Fit Elliott Waves into what you see on the chart. Okay? Actually, one of the things I want to talk about today, and we go onto that chart, the first one, is the biggest objection. There are two, I would say the biggest objection to Elliott Waves is that they're subjective. And what I often hear from other traders and analysts is, oh, but look, other methods of analysis are objective. So, for example, moving averages are objective. Yep. Trend lines are objective. Yep. Support resistance is objective. We should be using these instead of Elliott Waves, which are completely subjective. Here's what that argument is completely false. Because I guarantee you, Nick, you can have 5 traders look at this chart, and several of them will have different ideas of the chart patterns. Oh, this is a head and shoulders. This is the double bottom. Then you'll have some people saying, oh, that's a new trend. And say, oh, no, that's a reversion to the mean. That's not a new trend. And then you'll have people who use different kinds of moving averages. I've been on this show. I've seen people use different kinds of old flavors of moving averages. Yep. And, sorry, you're going to say something?
No, I was purely, in terms of moving averages, you should be basically back testing them every day, okay?
Yeah,
and that's time consuming. But
and also, I would say that, Nick, that trend lines, if we just go back to that middle chart, trend lines, one of the things people don't understand is that they're also subjective because it depends on where you draw them.
Close, an intraday high.
Absolutely. Okay. For example, do we draw from the top of the Brexit vote, from the middle, or whatever? Then you got the breaks of support and resistance, which completely fail, which brings me to my next point. I would say this, the more objective your analysis or your tools are, so if you're using very objective methods like, again, moving averages, support resistance, trend lines, guess what? Institutions know people are using them because they're written in textbooks for people to learn from, and they manipulate those levels. So what maybe folks are not aware, and if you've ever read the book by Michael Lewis, I think it's The Big Short, and Flash Boys, he talks about how institutions have built highly sophisticated algorithms, what they're called high-frequency traders, and their job simply is to manipulate the price and essentially manipulate investors and trader behavior. Okay, if we just go back to that chart, I just gave you some examples of this. So, as I've written on this chart, all above technical tools and many others are manipulated by HFTs, by high-frequency traders, these sophisticated algorithms. Take a look at the first one. The price goes below the 200 moving average. I guarantee you, Nick, you read every textbook or article written about the 200 moving average, they all say the same thing. A break or close below the 200 moving average is a bear market, or we're now into a bear market.
But invariably it snaps back up.
Absolutely. And algorithms know this, and they deliberately manipulate the market in that way because they know people are looking for these signals, oh, bear market and all that. So then you get a break of a trend line, you get a break of a support resistance, exact same thing. As soon as you get those breaks or closes below the support resistance levels or moving averages, there are people called, these are called breakout traders. Breakout traders look at that breakout of the support resistance level of the moving average and say, okay, I'm going to go short, I'm going to go long. And guess what? They get slaughtered by the algorithms. Yep. By the high-frequency traders.
Okay, well, let's go on to slide number 2, because obviously you've now got an answer.
Yeah, I would say this. I think the fact that Elliott Waves has an element of subjectivity about it is a good thing, because it's less subject to manipulation. You can't easily code an algorithm to look at Elliott Waves. Very sophisticated and very complicated. So I would say this, the reason why I look at Elliott Waves is it's a leading indicator. Yep. It helps with context. For example, if you look at this S&P chart, we can know right now we are standing in the 5th wave of this long-term 5-wave trend in the market. So it gives us a leading indicator where we could be going next and a context of where we are. And also, here's the thing. People say, oh, well, Elliott waves change all the time. Well, guess what? That's because the market is evolving. The market is always changing as we form new highs, new lows, new corrections and all that. So yes, the market evolves, so do Elliott waves. So this is the great thing about it. And if you just go back to that chart, I'll just say one last thing about it. One of the most powerful things about Elliott waves is the ABC correction, those corrective waves that you see ABC on my chart. Because if you can find those 3-wave or ABC corrective moves, you basically know that you're very close to a new turning point. Yep. So correction is coming to an end, and we're now heading for a new move up higher or move down, a new trend or a new wave, essentially wave 3 or wave 5. So that's what I got to say about Elliott waves. Use them, don't abuse them.
All right. Alessio, as always, thank you very much.